India's billionaire count is set to double by 2024. That's according to Knight Frank, that goes on to add India will be the fourth largest home to billionaires in a decade. Real estate is seen as the biggest direct beneficiary of this, with Mumbai expected to break into the top 5 global realty hotspots. Manasvi Gilani compares India's top cities with the rest of the world.
The billionaire club in India is set to double in 10 years. That's one of the key findings of the report by Knight Frank, an international property consultancy firm. Knight Frank says India by 2023 will be the fourth largest home to the world's billionaires. By then, only US, Russia and China will have more billionaires than India. In absolute numbers, the billionaire club in India will expand from 60 in 2013 to 119 by 2023. The Knight Frank study also covers what is called ultra-high net worth individuals, that is those having more than $30 million in net assets, including the primary residence. This uber-rich class in India is also expected to balloon by 2023. Knight Frank pegs Mumbai's share of ultra-high net worth individuals to zoom by a whopping 126% in Mumbai to 1,302 and by 118% to 321 in New Delhi. Now why are we telling you this? Because all this means more and more Indians in the years to come will buy the world's most expensive properties.
See, vis-a-vis 2013 India, yes, 2014, I can see more of the high net worth individuals. They're planning to increase their allocation towards real estate. So that is number one. Very important, another finding is that, when we asked about the allocation towards real estate, 43% of the UHNI, they said that they had already increased their allocation towards real estate in 2013. But in 2014, 60% of them said that they are going to increase the allocation towards real estate.
All this should be music to the ears of luxury property developers in Mumbai and Delhi, the largest home base for India's uber-rich. Knight Frank breaks down their real estate portfolio and says 79% of residential real estate in cities, 18% is in the countryside and 10% is by the waterfront. And at 48%, residential real estate holds a lion's share of the ultra-rich property portfolio, whereas commercial real estate's share is at 30%. Knight Frank believes wealthy Indians will also buy into other cities, with 2 southern cities seeming extremely attractive.
Mumbai definitely is there, but in my opinion, even Delhi and Bangalore could be good cities to invest in. Bangalore, as you know, that ITITS is really picking up now, and more so when Eurozone and US economies are showing some sort of green shoots of recovery with some sort of advantage in the exchange rate. I think ITITS driven markets like Bangalore, and I would also like to put some sort of importance to a city like Hyderabad, because the political uncertainty which we had, it's at our back now. So there is at least some sort of clarity about the political scenario, and trust me, Hyderabad has a fantastic infrastructure facility. It's not only physical as well as social. So I would see some sort of tractions in Hyderabad as well.
While their prospects look good, it'll all probably take decades for Bangalore and Hyderabad to catch up. Mumbai, on the other hand, Knight Frank says will break into top 10 global cities. As of now, Mumbai ranks 9th in the global cities for the most expensive luxury residential real estate, with an average weighted price of 60,000 per square foot for weekend properties in areas like Colaba, Nepean Sea Road and Worli.
This seems modest. Yes, you heard me right. Mumbai's property prices seem modest, but only when compared to that of the other global cities.
It's not a global city, but Monaco is on the top of the price list. Monaco, which incidentally has the highest number of billionaires in the world per capita and levies no personal income tax, is also the most expensive according to Knight Frank, with an average price tag of 3.48 lakh per square foot. Hong Kong's average price for prime residential real estate is at 2.82 lakh per square foot, London at 2.29 lakh per square foot, Singapore at 1.77 lakh per square foot, New York at 1.44 lakh per square foot, and Dubai is cheaper than Mumbai's prime real estate at 40,000 a square foot, but more expensive than Delhi's, that is 33,000 a square foot. Bangalore seems quite distant at 17,000 per square foot.
Whatever pent-up demand is there, I think the real estate sector, mainly the developers, need to really, take advantage of that pent-up demand when the political scenario and political scenario is settled and all confidence, comes back in the market. So if there is any, and there is a lot of oversupply as well. So if there is any price rise, I would not expect before the second quarter of 2015.
Price appreciation in Mumbai and Delhi also lagged behind in global peers in 2013, a direct result of shrinking disposable incomes and overall economic slowdown. In 2014 too, Knight Frank is not expecting prices to escalate significantly. While prices in 2013 rose by 17% in Beijing, 10% in New York and 8% in London, they went up by a mere 3% in Mumbai and less than 2% in Delhi. The top spot of highest price appreciation was grabbed by Indonesia's Jakarta at 38%. Call it a coincidence, but don't forget in the last few years, we've heard a clamour of Indonesia to relapse India in the BRIC nations. Now let's get commercial. Mumbai may be India's commercial capital, but it's cheaper than Delhi for prime office space. Delhi's Connaught Place is on the top at 43,000 per square foot, Mumbai at 30,000 per square foot, and Bangalore at 18,000 per square foot. And like in cases of residential real estate, prices in India's top cities for commercial real estate are dwarfed by their global counterparts. Hong Kong ranks in one office skyscrapers index with an average price of almost 4 lakh a square foot, Tokyo at 2.43 lakh a square foot, New York at 1.48 lakh a square foot, and both London and Singapore at 1.7 lakh a square foot. But India came on the top of the highest rental yields across Asia. Standing tall was Bangalore at 10.5%, Mumbai at 10.25% and Delhi at 9.85%. Hong Kong in comparison had yields of a distant 2.80%, Singapore at 3.4%, Tokyo at 4% and Sydney at 6.55%.
All India, UHNI, the portfolio, the real estate portfolio is divided into property towards residential property, allocation towards residential property, which is 48%, and office is 30%. Now, when we asked the respondents that whether they are going to increase their allocation towards residential or office, then 63% said that 63% of the UHNIs, they said that they are going to increase the allocation towards residential, and 65% of the respondents, they said that they would increase their allocation towards office, all in 2014.
India's uber rich is also hoping the Reserve Bank of India will relax the forex norms and allow them to repatriate their funds to buy some marquee assets overseas. But till then, there's too much to choose from even back home. In Mumbai, Manasi Gilani.
With the rupee stabilizing around the 60-61 level, it will be interesting to see if the Reserve Bank will lift the ban on Indians buying properties overseas. On that note, we're going to step into a short break. On the other side, we answer viewer queries on Property Doctor. Stay tuned.